Ladies and gentlemen, today I invite you to explore one of the most powerful ideas in modern mathematics and economics, an idea often referred to as the trillion-dollar equation. This phrase does not merely describe a single formula written on a chalkboard. Rather, it represents a class of mathematical models whose implications have shaped global markets, driven financial innovation, and at times shaken the very foundations of the world economy. At its core, the so-called trillion-dollar equation is most commonly associated with the Black-Scholes equation, a groundbreaking model developed to determine the fair price of financial derivatives, particularly options. Before its introduction, financial markets operated with a significant degree of uncertainty when it came to pricing risk. Traders relied heavily on intuition, experience, and imperfect heuristics. However, the emergence of this equation marked a turning point, a moment when abstract mathematics began to directly influence trillions of dollars in real-world transactions. The equation itself is a partial differential equation that models how the price of an option evolves over time, taking into account variables such as the underlying asset's price, time to expiration, volatility, and risk-free interest rates. What makes it so remarkable is not just its mathematical elegance, but its ability to transform uncertainty into quantifiable risk, enabling traders and institutions to make more informed decisions. To understand its significance, consider the nature of financial derivatives. These instruments derive their value from underlying assets such as stocks, commodities, or currencies. An option, for example, gives the holder the right, but not the obligation, to buy or sell an asset at a predetermined price within a specified time frame. Pricing such an instrument is inherently complex because it depends on future events that are uncertain. The Black-Scholes framework introduced a method to construct a risk-neutral portfolio, effectively eliminating uncertainty through continuous hedging. By doing so, it allowed for a deterministic valuation of options, which was revolutionary at the time. Suddenly, financial institutions could price contracts with a level of precision that was previously unimaginable. This breakthrough did not remain confined to academic journals. It quickly found its way onto trading floors, into investment banks, and across global markets. The economic impact of this development has been profound. The widespread adoption of the trillion-dollar equation enabled the rapid expansion of derivatives markets, which today account for not just trillions, but hundreds of trillions of dollars in notional value worldwide. These markets provide essential functions such as risk management and price discovery, allowing businesses to hedge against fluctuations in interest rates, currency exchange rates, and commodity prices. Airlines, for instance, use derivatives to lock in fuel prices, while multinational corporations hedge against currency risks in international trade. Without the mathematical tools to accurately price these instruments, such activities would be far more speculative and significantly riskier. However, the story of the trillion-dollar equation is not solely one of triumph. It is also a cautionary tale about the limits of models and the dangers of over-reliance on mathematical assumptions. The equation rests on several key assumptions, including constant volatility, continuous trading, and the ability to borrow and lend at a risk-free rate. In reality, markets are far more complex and often behave in ways that deviate from these idealized conditions. Events such as market crashes, liquidity crises, and sudden spikes in volatility can expose the limitations of the model. One notable example occurred during the 2008 global financial crisis, when the misuse and misunderstanding of complex financial models contributed to systemic risk. While the Black-Scholes equation itself was not to blame, the blind faith placed in quantitative models highlighted the need for a more nuanced approach, one that combines mathematical rigor with human judgment and an awareness of real-world complexities. Despite these challenges, the influence of the trillion-dollar equation continues to grow. Advances in computational power and data analytics have enabled the development of even more sophisticated models that build upon its foundation. Techniques from machine learning and artificial intelligence are now being integrated into financial modeling, allowing for the analysis of vast datasets and the identification of patterns that were previously undetectable. Yet, the fundamental insight remains the same, that mathematics can serve as a powerful tool for understanding and managing risk. This insight extends beyond finance into other fields such as engineering, physics, and even epidemiology, where similar mathematical frameworks are used to model complex systems and predict outcomes. From an educational perspective, the trillion-dollar equation serves as a compelling example of the practical relevance of mathematics. It demonstrates how abstract concepts can have tangible, real-world applications with far-reaching consequences. For students and aspiring professionals, it underscores the importance of developing strong analytical skills and a deep understanding of mathematical principles. At the same time, it highlights the need for interdisciplinary thinking, as the most impactful innovations often occur at the intersection of mathematics, economics, technology, and human behavior. Moreover, the equation raises important ethical considerations. As financial models become more powerful and widely used, questions arise about accountability, transparency, and the potential for misuse. Who is responsible when a model fails? How can we ensure that these tools are used in a way that promotes stability rather than exacerbates risk? These are not purely technical questions. They require thoughtful engagement from policymakers, regulators, and industry leaders. The challenge lies in striking a balance between innovation and oversight, ensuring that the benefits of advanced modeling are realized without compromising the integrity of the financial system. In conclusion, the trillion-dollar equation represents far more than a mathematical formula. It is a symbol of the transformative power of human ingenuity. It illustrates how a single idea, grounded in rigorous analysis and creative thinking, can reshape entire industries and influence the global economy. At the same time, it serves as a reminder of the limitations of our models and the importance of humility in the face of uncertainty. As we continue to advance into an increasingly complex and interconnected world, the lessons embodied in this equation remain as relevant as ever. They challenge us to harness the power of mathematics responsibly, to question our assumptions, and to remain vigilant in our pursuit of knowledge and understanding. Ultimately, the true value of the trillion-dollar equation lies not just in the wealth it has helped create, but in the insights it provides into the nature of risk, innovation, and the ever-evolving relationship between theory and reality.